What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Peggy Beauregard. How you doing today, Peggy?
I'm doing fantastically great. Thank you, Dan, for inviting me. I really appreciate it.
Awesome, but I got some great news for you, Peggy. Today, we are joined by my very favorite audience member. And why is my favorite audience member here today? It's because this is a chance encounter where I interview commercial real estate syndicators. That means buyers, sellers, investors, all that kind of stuff. And why would I do such a silly thing? Well, if you know about off-market or private deals, also known as 506B deals, you'll find out that the SEC wants you to have documentation of your prior substantive relationship, or else they get ants in their pants. So I need to interview everybody, make sure I know their level of sophistication, appetite for risk, and all that kind of fun stuff. But the payoff for you is you can learn how to effectively communicate on the subject of a commercial real estate deal, and you find out how my guest fits into those. But before we get into all that nitty gritty, Peggy, do you want to say a thing or two about yourself?
No, I'd rather say it about you. So I met Dan about a year or so ago, 2 years ago. I can't remember. I came on this show that he has every Tuesday morning, and it's called Figure It Out. And I have to say, it's one of the most interesting of all the meetings I go to, all the real estate meetings. Yours is the most interesting because we actually get to figure it out. Like yesterday, you had a gentleman on who's looking at investing, and the way he's doing his due diligence is, in my opinion, my humble, which I'm not humble when it comes to opinions, is he needs to be doing it a different way because he wants to bring in investors, and investors are not going to invest with somebody that's saying, I want $200 a door cash flow. Like, that's just not going to make it.
Yeah, that's definitely it.
I love your show. I do everything I can to be on it every week.
I
This
really
is so much
appreciate it.
fun, and we have very interesting conversations that really expand our minds and our communities.
It's so nice of you to say. I really love that. So, but the first segment that we have here, it's the 5 distinct motivations. Before I get to that, I always say, but wait, check your 8. Peggy, I don't know if you can see through your camera and into the audience's device, but down there at the 8 o'clock, there might be this, it's hideous, this subscribe button on their screen. And if they just like click on it, okay, it's a silly joke and I do it in every episode. It's ridiculous.
Okay. I saw it, but it was on top, not on bottom.
Yeah, it's down there on their screen, and there it is. But anyways, those jokes aside, the 5 distinct motivations. I've talked to a whole whack of commercial real estate players, and everybody has their own unique why. But when it gets down to brass tacks, I find that they fit pretty nicely into these 5 different distinct motivations. And knowing these motivations is very important because commercial real estate deals are complex. They take months, and there are risks involved. So I need some sort of reason why the person's actually going to follow through with it. So these are the 5 I've found. The first one, my favorite one, but it doesn't really describe me, it's preservation of purchasing power. What's that all about? Well, some people already have a portfolio of assets, and the way that they make ends meet is from the proceeds of ownership. So why would somebody like that still make another acquisition? Well, there are a couple circumstances that are pretty obvious. One is if inflation rears its ugly head, excuse me, and it eats away at the purchasing power of that cash flow, it's time to make a new acquisition. Other than that, the other times are when you're buying at a steep discount due to distress or some sort of asset crash, and that's what some people are up to. Me personally, it doesn't describe me all that well. What describes me better is trading time directly for wealth. I've got a background in technology. Specifically, it's the CRM industry, specifically the ones that actually accept credit card payments. So all this digital online security and eventually doing it for real estate, it made me a high salary, high wage earner. But the problem with that is you're paying more in tax than anybody else. So as I was looking at my boss who was flipping 10 houses a month, I was going like, well, how do I pivot where instead of paying all this income tax because of the high salary, I'm getting rewarded in the form of deployed capital, aka equity. So that's why I made this switch into this business. But that's too abstract for some people. Some people, they get into this business, they see lots of zeros involved in the transactions, and they're getting into it because they want to fast track their retirement. But more specifically, they want to take control of their own schedule. So maybe that means working fewer months per year or working fewer weeks per month, something like that. But the idea is people who choose this one, they're looking to scale back at some point. And that's not true of this next group. They are so ambitious. They want to buy their entire hometown. They want that generational wealth. They want to make sure that their great grandchildren never have to hold a day job for any real period of time. And that's fantastic because people who choose this answer, they're going to be hustling into their 90s. They're just going to keep on going and going because they just want to build and build and build. And that's a little bit similar to this last group though. But the last group, they found a sector of society, or maybe it's the environment, maybe it's animals, who knows what it is, but they want to make a big impact. And to pull that off, you need a serious financial backing. So that's why they're making their commercial acquisitions. But Peggy, as far as you're concerned, I know that you don't actively work on the actual deals, but of those 5 different motivations, what jumped out to you? What do you think describes you best?
Oh, let's see. Well, I already did all of that. I already jumped in. I already bought it. I already built it. I flipped it, or I was a lender, or I held it. 40 years I've been in the business. I've been in it since before the 2000s came around when everything started changing. So what happened for me was, as I grew a little bit older, you might say, I decided I didn't want to be doing all that rehab work. And I've done all of it myself. Laying tile floors and doing bathrooms and all of that. I wanted to become a passive investor. And when I got into that, I realized there's so many people that could use passive investing rather than having to go learn everything there is about real estate, because I did pay my 6 digits to learn all about this with everybody you can think of pretty much. And it's so much easier to have the money you have been saving and your IRAs to be investing passively, so you could do what you love and not have to worry about, oh, am I screwing this up? Am I losing money for my investors? Did I do my due diligence right? Do I have enough experience? So working with a passive investor and building theirs and talking to them about their children who do need to do something with their life. They should never be trust babies for everything. They need to, I mean, look at what Warren Buffett says. You give them enough to do some things with, but not enough to live their life. And I'm of that, even though I don't have children, my family's of that same thought process, that they teach their children so their children could stand on their own 2 feet.
I love that. I love that. You know, me personally, you know, like I was getting my paycheck from real estate before I actually started doing real estate deals. And that's when I had kids, was when that started. And before that, I always thought that knowledge would be the only thing I'd be able to really pass on to them. And so I knew I knocked that out of the park, but then I got into commercial real estate. So I think we'll be able to do a little bit better than passing along just knowledge, which is great.
Yeah.
But there are risks involved in all this kind of stuff. I like to make the joke that real estate is the world's 2nd oldest profession. And so it's very, very competitive, right? There are also risks involved, and people need to get their head around that. And if you've ever been involved in a private deal, a 506B syndication, you probably had to fill out this questionnaire. The securities attorneys, they insist on it. And it's really invasive. It asks you all sorts of financial questions that you're probably not going to be comfortable, you know, filling out. But the question that bugged me the most was the one about tolerance for risk. I felt like it didn't really prove anything. And so on this format, I use this question to make sure that people understand that there are risks involved. It's a fill in the blank question. So Peggy, there are many popular investment asset classes, but I think blank is too risky? What's too risky for you? It can be inside real estate, outside real estate. What do you think is too risky?
The stock market.
Stock market. Yeah.
The stock market. Yeah. My feeling about that is when you look at compare real estate to the stock market, when you're in real estate, let's say you put $100,000 into a
Property. Yeah.
investment, right? A property. You're secured by the property. You've got that 100,000. No matter what happens, even if a cash flow stops, you still got that 100,000. In the stock market, if it goes down, you just lost that money,
Mm-hmm.
all of it.
Mm-hmm.
Or
Mm-hmm.
maybe it just went down a little bit, but it has to double to come back to break even. It's just way too risky for me. I can't be in the stock market. People
Mm-hmm.
think I'm crazy because I'm 100% in real estate, but I'm spread out in real estate. I'm in all kinds of asset classes with all kinds of different money. Some of it's growing and some of it's cash flowing. And you set up, you have to look at how you want your portfolio to work for yourself, for your family, for all of that. It's not like, oh, I'm just going to go into real estate. You need to have a plan. You need to be working a budget. And you, Dan, you need to have your children working in the business so that they are educated and will continue that. So many parents don't do that because they think their kids are too young to learn, but after 3 years old, they are not too young to learn. And then you hand it to them when they're 50 and they're like, oh, we don't want it. Or you die and they're like, they sell everything. You worked your tush off for that and then they sell it. Like, hello, we didn't educate them, which I'm sorry, I do think education is super important.
Yeah, I absolutely agree. And here's my segue. My subtle little reminder to subscribe, but this is the segue into the Dan Does Deals Core Competency Cube. You can get your own copy for free at dandoesdeals.com. I don't even ask for your email address, but what is it? It has the 6 different roles in a commercial real estate deal. And the reason why I don't even ask for your email address, which is the dumbest thing you can possibly do from a marketing perspective, you should always ask for contact information in return for your freebie. But the reason I don't do that is because I actually want nothing to stop you from going to the site, printing it out, and practicing on these 6 different sides. And the reason why it's so important to me is because I think if you're going to have a future in this sector, effective communication on how these deals work and how the teams are built, it's essential. That's absolutely important. And it just takes 2 minutes to go through all the different sides. And once you've heard it, you know how my guest fits into these deals. So let's get started. The first one, the repositioner, is an acquisitions person. They look at a bunch of different properties. They do a bunch of different paperwork. What do they do with the paperwork, you may ask? Probably won't. It's underwriting. It's a fancy word. Underwriting means doing the math, and you have to do the math because you need to make sure, first of all, is this property actually even making the amount of money that the seller / broker claims it is? Because it's not a guarantee at all. But why is the repositioner doing this math? Well, they're looking for upside. They're figuring out how can this property make more money than it is right now. And one part, which is one of Peggy's fortes, that is part of every repositioner's job, is you have to have investor relations with financiers. So those are people who only deal with paper and money. That's where you get your loans. And so the reason why that's so important is because if you can get a more advantageous loan, that goes straight to the bottom line, aka profitability of the property. So cheaper money means more profit. So that's why repositioners spend so much time with financiers. But the more understandable, simpler way for a repositioner to find upside is to make the operations more efficient, to stop those Benjamins from going down the toilet. But of course, there's more to operations than just unclogging toilets and mowing lawns and replacing light bulbs and collecting rent. Me personally, because of my background in marketing, content creation, and automation, it means that even if we are outsourcing to a third party for our property management, if we have a vacancy rate problem, for example, I can use my marketing chops to fix that all up, which is an important part to GP teams. But operations, more efficiencies, it's probably not going to be enough upside for a lot of repositioners. So they're going to get a contractor team involved. They're going to do a value add. They're going to do the renovations on the units, because the next resident with the upgraded unit would be more than happy to pay more in rent than the previous resident before it was upgraded. But of course, it's still not that simple. You can spend all the money you want on contractors, like if you're gold plating toilets, but are you going to get a return on investment? Are they actually going to use the materials that they ought to do a great job? Well, I don't know if you know this about me, but I'm from the internet. So that means I need locals. I need boots on the ground who can be there in an hour or two, because you can bet it's not going to be me. I'd still be stuck at an airport in an hour or two if I had to get there. So that's why it's so important to have somebody who can keep an eye on the contractors' jobs, make sure they're keeping the schedule, not cutting corners, make sure that the operations are doing what they're supposed to be doing. That's the local's job. But when the repositioner has found a property, they turn around to the financiers and they say, hey, this is great. This property, it's 350 units and it's tens of millions of dollars. You don't happen to have, I don't know, tens of millions of dollars you want to lend us, do you? Well, the financier is going to have one other question that is pretty burning, and a lot of coaches and gurus, they gloss over this, and I'm not happy about it. And that is, they're going to say, who's your sponsor? Who's the KP? What's that all about? Let's do a hypothetical. You're a doctor, you're a physician or an engineer or something like that, and you and a few of your friends want to pool some resources and take over a commercial property. What's stopping you? Well, the answer is you're not going to be eligible for a commercial loan unless somebody in the fold already owns a similar asset. Okay, so if you want a 350 unit apartment complex, you got to find somebody with a 350 unit apartment complex, or else the bank's going to say no. On top of that, you need a certain amount of liquidity, and then among the owners, or possibly borrowing from a KP's balance sheet, you need a balance sheet of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Peggy, I already mentioned that financier and investor relations is a lot of where you focus. Did you want to expand on that, say another few things about it, or?
Well, people who are brand new, they're too risky. Can't work with too risky. Our job is to protect the investor, to make sure they don't lose their money. So we work with experienced people. So what you just brought up is super important. You got a bunch of doctors that want to buy something, great, but who is the key person, KP, key person that's got the experience, that's done more than one, probably preferably 10 deals. I know some family offices will only work with someone that's got at least 10 years in. We heard this fellow the other day. I'm like, oh my God, like 3 people are going to qualify to work with them. But hey, that's what their parameters are. You got to have so many hundreds of millions of dollars of assets and so many years. It's really important, because if you don't know what you're doing, you don't know how you're going to make money. Like all of that. And then a lot of people just give you a pro forma. They don't give you the actual incomes and expenses. They don't show you exactly what it's going to cost to rehab a unit. They're out. You know, they got it. They need to send. For us, you underwrote it, but we vetted out, and I have a whole checklist. By the way, I have a checklist. If somebody would like to have the checklist, it's just a checklist of what we vet out on somebody who's already done all the underwriting. And we also work with people that don't borrow money from the bank. So they bring in all limited partners. So they don't, and good thing, because they had a couple problems and they lost all their tenants, and now they're repositioning, but thank goodness for that, or we would have all had to do capital calls. And they still have the reserves so they could pay the insurance, but there's no mortgage to pay. And when you're buying a $30 million property, right?
Yeah, that debt service is not a joke at all. But the next question I have then, it's about the buy box, and I should mention that, like, even when I first started doing this show, because I'm not the sponsor KP, like if somebody turned around and asked me, "Hey Dan, what's your buy box?" I'd say I'm pretty agnostic about it, because it really depends on the sponsor. But just so that you can talk about this stuff, when commercial real estate players are asking, what's your buy box, what's your ideal property, what's easier to say yes to and more difficult to say no to, we're asking for 3 different things. The first one's geography. Which states, which counties, possibly even which neighborhood. Okay, that's really going to matter before somebody makes it a no-brainer decision. The second one's going to be size. And most of the guests that I have here on Chance Encounters are in multifamily, which means apartment complex investing. And the way that you choose the size or define the size in multifamily is by unit count. And it's important because you're going to have a completely different group taking over 5-unit apartment complexes compared to 150 and up unit apartment complexes. So that size matters. In other forms of commercial real estate, it might go by square footage like warehousing or industrial. But that size matters. The third thing, though, is called class. And I got to confess, one of my pet peeves is when people use the exact same word for more than one completely different thing. And that's something that they do with class. And I split it up into 2 different words. The first one is condition. Okay. And that means how old is the property? How beat up is the property? Is it in reasonably good shape? And then what about luxuries and amenities? Like, is it, like really bare bones, there's no amenities at all? Or is it really flashy with gyms and all that kind of fun stuff all included? So that's condition. The other meaning of class I call area. And when they're asking about area, they're talking about what are the school districts like where the property is located? What's the crime rate like where the property is located? And then, of course, how desirable is it in general, which has more to do with how many people go buy that property in any given day. But both of those 2 meanings of class, area, and condition, they are rated the same way as in grade school, with A+ at the top, and then A, and then A- and B+, and so on. But Peggy, as far as you and your crew go, again, like you're going to go off of the sponsors more than other things, but what other things can you say about the buy box?
Yes, so that's a very long answer, because we work in all asset classes of commercial. So that's all different. So one of my gurus from years back, it is not location. It is time, price, location. So all that makes a difference in what class asset you're buying. If you're going to reposition it, so let's say you buy a multifamily C class, you're going to reposition it to a B or B+ because you are in a B area, but you're in a C. And then you have to look at, well, if they don't tear it down and rebuild it, it's still built in 1978, but you've brought it up to date. So you've brought it up to another class asset, and you can't change the location, right? But when you're an industrial, does that really matter? So they're all crappy buildings anyway. They all need money put into them. Whoever was there last time didn't clean up after themselves. So you have all that environmental stuff to work with. Sometimes, not always. And then you've got retail, right? And retail, a whole nother thing. You'll find those in A, B, C, all different class assets, right? And the one thing about most retailers, not all of them, is they keep it looking good. They upgrade it every so often. So in the last, actually over COVID, because a lot of people were closed, they threw a bunch of money into places, and you'll go, hey, what happened to that shopping center? It looks so much different now. Yeah, they painted it. I was kind of blown away at how much money was thrown into a lot of property. So everything you brought up is really important. The size will depend on how much money they have to put into it to fix it up, right? And it's really all about the net operating income. That's what's going to determine, does it matter if it's 20 units or 150 units? What really matters is the sponsor. So we're working with a group right now. They're buying all the small units. They're buying like up to like 50 or 60 because there's no competition there, which makes them smart. And they're rehabbing everything. So they're cleaning them up, making them nicer. They're in the Midwest. And now they're going to have this big, huge portfolio because it's a fund. And in 10 years, that fund will look enormous to some REIT group, which will come in and buy it, right? So there's so much more than just the 3 things you brought up. Did I cover them all? The area, the size, the class.
Yeah. So yeah,
Here's what's important. You should stay classy.
Yeah, for sure, exactly. So basically agnostic, that's cool. The next question then, it has to do with the ideal people to reach out. And of course, we all have our own unique skill sets. And because multifamily is so commercial real estate in general, it's so multifaceted, and nobody's going to be all six sides of this die for any meaningful amount of time. We're always eager to build these teams and give referrals and all that kind of stuff. But again, because of our unique skill sets, we're going to be better off helping some people more than others. Me personally, because I'm from the internet, the sponsors and KPs, I always have to reach out to, because they have the foundations where a guy like me makes a bigger difference. And of course, also being from the internet, the locals are very important to my business. So I know who can be accountable, who can keep everybody on their toes. So that's who I'm looking for. Peggy, I imagine, because you're a financier, you're generally looking for people who want to do passive investments, but who on the die, who do you really hope reaches out?
Oh, we're looking for people who will have their IRAs. They'd like their IRA. Almost everything we work with, well, actually everything now. We had a gas and oil company, and they just finally were able to take self-directed IRA money. So people that have a retirement, they got to have a minimum usually of 100,000, because that's what's required of a accredited investor or a B. Doesn't matter how much money. It doesn't matter what your status is. It matters how much. And then we like to have a discussion about what's best for you, because it's not just about the investment. We're here for basically the rest of your life. Somebody will be there. I don't know that I will be. If you're 20 years old, I could be probably your great grandma, but I don't have kids, so I never feel old.
Right.
That makes any sense. You talk about, look, we work the whole United States, and we're actually not doing anything in California, which is where I live, because the returns are just not there. We don't like to work at anything under double digits. We do a little bit of 8% cap rates, but almost everything somewhere between 10 and 30%. And people think, oh, that's too good to be true. Look, my background, we never got anything less than 10%. Back in the 90s, you bought an A-class turnkey property, did not have to put a dime into it, and got an 8 cap. You got 8% on your money. You didn't have to do anything for that. That was called turnkey, 8%. And now you struggle to get anything close to that. But so double digits for me, here's what I like. I'm working with people that have been around for a long time. They understand double digits are the only way to go, and they're not risky, because you're working with people that know what they're doing. That's the most important part. You got to protect yourself. People throw their money into the stock market. They don't know who's running the company. I don't want to go there.
Right.
So,
The one that bugs me
get
about
back to
stocks is that, they got a full PR department, and what's a PR department for? Public relations. It's to spin whatever's going on to make it sound nicer. And when you're dealing with these, these individual properties, these different sponsors, they don't have a PR department. You're talking to the person who's talking to the property managers every single week. So you get way closer to the truth, and you get a better idea of what you're going to do. So that's what I like about this part of the industry. But this has been really great. As far as reaching out goes, you got your information on your background, and I got a pretty distinct last name, so I'm pretty easy to find, especially on LinkedIn, where I spend most of my time. This QR code, if you scan this with your phone, it goes to the FAQs page of 506 BME, which is the platform I offer syndicators to document your prior substantive relations. And that is in case, once you get to a certain amount of assets under management, the SEC will audit you. And the thing that they're looking for, especially if you're doing B deals, is the documentation that you actually knew people before you pitched them, your private deals, and you're not just pitching people all willy-nilly. But Peggy, you got your QR code, you got your website on the screen there, the nesteggbuilder.com. You also have your show, but how do you prefer people reach out to you?
Yeah, our show. We have a show that's every week, and we have different speakers come on. We actually have the people that we're working with, the sponsors, come on and pitch their deals. And then we have educational people, like somebody's coming on and talking about 401ks, and we have self-directed IRA companies come on, and we have CPAs, and attorneys and people that will educate you. We have somebody coming on talk about cost segregation and whatever you want, just send us an email and tell us what kind of speaker you want. We'll go find them because it's all about your success, not about our success. It's not about us. It's about you and how you grow and the influence you have with your family and your friends.
I love it.
That. Did that answer your question?
Yes, it does. And another thing that I got to mention is it's not for you, Peggy. It is for you in the audience. It's my public service announcement, which is if you've been watching this episode and you've been experiencing like searing pains in your eyeballs and like migraine-like symptoms, I'm confident it's the hideous subscribe button that's right there. And if you click on it, it goes away. It's totally free. And of course, the reason I'm letting people know this is because if enough people click it, then YouTube will pay for these videos instead of me, which sounds amazing. And the only trade-off for you, as I said, it doesn't cost anything, but my videos might show up on your list of suggestions, but you can go ahead and ignore those suggestions because I just appreciate the fact that you spent this time with me. Just like Peggy, I appreciate you joining me today. This has been great.
It's been fun. Thank you very much. Really appreciate the interview.
Sweet. Thanks.
Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay, are you already logged into 506B me?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506B me, everybody.